First Solar reported earnings earlier this week, in which it topped estimates and raised the lower end of its guidance. First Solar is breaking from the trend of bad news for solar stocks and the entire industry in general. It has a fortress balance sheet and balanced approach to growth, which is expected to drive value for shareholders. It's one of the reasons why Jim Cramer said it's the only solar stock he's recommending these days. Now for some inside scoop into the earnings and the solar energy market in general, let's watch this video. It is coming from First Solar CEO Mark Whitman.
Joining us this morning in a CNBC exclusive is First Solar's CEO Mark Whitman. Mark, it's great to have you. It's such interesting times right now in the business. There's a big argument that pricing and demand and even the business model sentiment is at an inflection point. How are you reading what we've been through this year in the space?
Look, I think on the utility scale space, it's been a very strong year, and it continues to be a strong year. Look, there are some sentiments and some challenges that are going on in the residential space, which really aren't applicable to us. We focus, and we have historically, over the 20 years of the company's existence, on the utility scale segment of the market. There's a lot of load growth going on in many parts of the U.S. You know, we're headquartered here in Arizona. We're seeing a significant amount of load growth here in the U.S., across other parts of the Southwest, going across the Southeast into Florida. And that's really what's driving a really robust, strong demand for us and our technology. Yeah, we booked slightly lower bookings last quarter, but still booked almost 7 gigawatts, which was about 65% of this year's actual production capacity. So we're still very encouraged, and we see very strong demand and robust pricing and a great environment as we continue to move forward.
How much of next year do you think is going to be about policy and elections that drive policy?
Look, since the Inflation Reduction Act, there clearly has been an influence and an impact, which is largely focused on the U.S. trying to create an environment where there's long-term energy independence and security, and creating a domestic industry that hopefully creates cycles of innovation. And that's largely what's been happening over the last year or so. At the end of the day, the policies are important, but at the same time, there's a fundamental need for energy. Solar is the lowest cost form of new generation. We're starting to see more solar integrated with storage, which is sort of expanding the addressable market in terms of the hours of the day where solar energy can be deployed and dispatched to meet the end consumer demand. So yes, there's a policy environment, but there's also a fundamental need in demand. But we have to keep them both in balance. I mean, it's clearly important to stay engaged and involved in policy at the state level and at the federal level.
Carl referenced the pricing. What's going on there in terms of pricing pressure in the business for the panels?
One thing to remember, we're pricing out really to the end of this decade. We have a multi-year contracted backlog that goes out to the end of this decade. So we are pricing forward. There historically is an environment where, as we move forward, we would expect technology advances to help drive the efficiency of our technology to a higher level, which will drive to a lower cost, which in theory drives to a lower ASP. So near-term pricing has changed a little bit in the U.S. We also sell quite heavily in India. India has been a market that pricing has held up pretty well. But as you go across the horizon, when you're selling out into 27, 28, 29, sure, you'll see a slightly lower price in an ASP environment. But what we just booked this last quarter was effectively a flat ASP to the prior quarter. So we've been very disciplined in how we're engaging the market, holding firm on pricing, and been able to be successful doing that.
What about the efforts to reshore solar and EVs from the Chinese market? How is that going? And what's the right way to do it when you think about how much it should cost and whether that cost makes sense with the economics?
So it's actually going extremely well. If you look at the U.S. market, we have, just as on our own, since the announcement of the Inflation Reduction Act, added about double our capacity that was planned at that point in time for the U.S. market. And others have done very similar things. And we were growing before even the Inflation Reduction Act was announced. We already were in the midst of adding another factory here in the U.S. and adding another factory in India as part of our Southeast Asia operations. But the opportunity now, with the announcements, if they were to come through, at least at the module assembly level, in the U.S. will be more than self-sufficient to meet the demand expectations through the end of this decade. It needs to be done in a thoughtful, balanced way, strategic, insightful. The one thing I would say right now, we are a vertically integrated manufacturer. Therefore, we do the entire production process within the four walls of our manufacturing facility. Our competitors, which use a different technology, largely are only bringing module assembly into the U.S. market. And we need an enduring supply chain that is all the way from the production of the polysilicon, which is the very first step of the crystalline silicon production process, all the way through the module assembly. So what I would say right now is what's gapping, at least with our competitors, is that there's not enough vertically integration, such that when we get through the horizon for the Inflation Reduction Act, we have an enduring domestic supply chain that will enable cycles of innovation and will also enable the U.S. to be a technology leader and to export into international markets. So that's the only complaint I would say I would have right now, is it needs to be a more vertically integrated supply chain. Again, First Solar is vertically integrated because our technology is different, but I'd love to see the balance of the industry to emulate what we're doing.
So this is the monthly chart on First Solar, and as you can see, the most recent highs were roughly at $230, which occurred back in June, and price is off. If you look from 60 to 230, prices are off roughly about half that, right? So about a 50% retracement. Let's scroll down to the weekly chart, but before we do that, this is the level that I'm eyeing. It's the 120 level. That was the previous high, and you can see how price came back, retested that, and then shot higher to the 130. So this was the intermediate origin of the move higher. Going down to the weekly chart, you can see how price continues to make lower highs and lower lows. Now what's interesting about the most recent price action, you have 4 rejection wicks or 4 selling wicks. Now again, price is off the lows, most recent lows, and we'll see where that came in, potentially on earnings. And price almost got to the support resistance band that I was looking at. Came within $7. So are the lows in? I'm not quite sure, as the solar industry in general is doing really bad. Alright, so let's go to the daily chart now. We can probably get some clues as to where price is heading next. All right. So key level that was broken was when price breached below and closed below the 200-day moving average. You also have what we call is a depth cross. That's where the 50 crosses over and below the 200-day moving average. You also have the 100-day moving average crossing below the 200-day moving average. So on a short term and intermediate term, price action is bearish. Right? This is your short term when the 50 crosses over the 200, and your intermediate term when the 100 crosses over and below the 200-day moving average. So short term and intermediate term were bearish on the stock. Now the blue line is your 13 and your orange line is the 26-day moving average. And price was respecting that until recently. So potentially prices are forming a bottom. Not to say we can't reach a lower low, but it appears that the momentum to the downside is waning. Now I want to look at this pivot low 132 and go to the left, and I love it. Rally. Here was your daily demand level, daily buyers. So that rallying price based on the rally out. When we put it all together, can't make this stuff up, folks. Depending on how you draw your zone, I typically draw my zones with the, we'll call this the proximal line at the top of the highest closing or opening basing candle. So let's see. If I do that, and I put my, because I want to catch the down wicks, turn that blue to represent a daily buyer's level, and let's scroll over, and we came right into that level here. All right, now on the top side of price, we do have an area in which I'm going to call daily sellers. So price is in the middle between daily sellers and daily buyers, but based on, again, the moving averages plateauing but starting to turn down, the chart suggests there's more downside risk. So put an alert at the 130 level. You might get a bounce again like you did on Monday of last week, but this is the level at 120 where you start to back up the dump truck, and hopefully that level gets hit really next year. And why I say next year, well, the markets will have digested Fed Powell more than likely not raising rates, and also we don't know if we're actually going into recession or not. So there's still some uncertainty out there. But if you are a believer in solar energy, for solar in general, the 120 level is one you put in your watch list and you set an alert. Thanks for watching. Subscribe. Please like the video.